the structural foundations of the global economy experienced a massive and highly volatile reallocation of capital today as international oil prices suffered a catastrophic single-day collapse to hit their lowest trading levels in over 2 weeks. The sudden macroeconomic downturn was triggered directly by escalating investor confidence that the United States and Iran are actively moving toward a definitive, binding diplomatic settlement to permanently end their volatile military conflict. Benchmark Brent crude futures plummeted by a staggering 4.25% to settle at $98.83 a barrel, while U.S. West Texas Intermediate WTI crude experienced an equally severe drop of 4.73%, sliding down to $92.03 a barrel. This rapid erasure of the war premium from global energy markets highlights how deeply tied international commodity traders remain to the shifting parameters of Middle Eastern military diplomacy. The sudden collapse in energy prices has provided an immediate, highly anticipated wave of relief to hard-hit civilian industrial sectors across Asia and Europe, which have spent months grappling with skyrocketing jet fuel costs and inflated electricity rates. In regional transportation hubs like Thailand, domestic airlines, and heavy logistics firms had recently issued stark warnings that the prolonged naval blockades in the Persian Gulf were driving commercial fuel expenditures to unsustainable highs, forcing municipal governments to draft emergency corporate bailout plans and consider higher infrastructure taxes to prevent a complete collapse of consumer confidence. The current pullback in crude futures is expected to rapidly ease these intense inflationary pressures across global supply chains, though financial analysts warn that the market's current optimism may be highly premature given President Trump's parallel public assertions that his administration refuses to rush into a flawed or unverifiable security pact with Tehran. Simultaneously, the dramatic shifts on the energy desks have triggered a broad, highly calculated restructuring of international currency markets, forcing the dominant U.S. dollar to give up a significant portion of its recent wartime gains. As the immediate demand for traditional safe haven assets eased across Wall Street and European trading rooms, the euro rallied noticeably by 0.37% to sit at 116.46, while the Japanese yen strengthened considerably to 1.11 per dollar. This widespread currency realignment reflects a profound pivot by institutional investment funds away from defensive, cash-heavy positions back into active global equities and emerging market assets. However, commodity strategists maintain an incredibly cautious outlook, emphasizing that because the underlying structural disagreements between Washington and Tehran regarding long-term nuclear enrichment controls remain entirely unresolved, any sudden breakdown in the current maritime ceasefire could instantly reverse today's market corrections, triggering an immediate, unprecedented spike in global energy prices.